BP just released its second quarter trading update, and the headline figure is hard to ignore. Profits more than doubled year-on-year, with first quarter underlying earnings already confirmed at $3.2 billion, the equivalent of $365 every single second. The same period saw fuel prices rocket at the pumps for British households, making this one of the more uncomfortable juxtapositions in recent corporate reporting. The source of that surge is not a mystery. BP's Customers and Products Division, the oil trading unit, reported $2.5 billion in profit, against just $103 million in the same quarter a year earlier. The entire step change traces back to one event, the effective closure of the Strait of Hormuz after the U.S.-Israeli attack on Iran, which sent Brent crude from roughly $60 a barrel to a peak close to $120. What began as a supply shock for consumers became a trading windfall for integrated energy majors with the infrastructure to route, buy, and sell crude across disrupted markets. What sharpens the investor dilemma is the timing. New Chief Executive Meg O'Neill delivered these results on her first formal address to markets, having taken the helm on April 1st. Hargreaves Lansdowne noted she had been cautious not to signal a step change in dividends and had not dropped any clues about the likely return date of share buybacks. A $3.2 billion profit beat against analyst expectations of closer to $2.7 billion, and the incoming CEO still withholds the capital return signal investors most want to hear.
The Q2 trading statement spells out the mechanism with unusual precision. Brent crude averaged approximately $97 per barrel in the April to June quarter, up from $78 in the first quarter and $67 a year earlier. BP expects that price environment to add between $1.8 billion and $2.1 billion to earnings in its oil production and operations segment, compared with the prior quarter. Stronger refining margins, the indicative figure rising to $29.60 per barrel from $16.90 in Q1, are expected to add a further $1.2 billion to $1.4 billion in the products division. Here is where the analysis requires precision rather than headline arithmetic. Oil trading is guided as slightly higher than the previous quarter, but the previous quarter's trading performance was itself described in the articles as exceptionally strong. The compounding effect means 2 consecutive quarters of historically high trading revenue. Simultaneously, net debt is expected to fall from $25.3 billion at end March to between $22 billion and $23 billion by end June, a reduction of more than $3 billion in a single quarter. That debt trajectory, with BP targeting $14 billion to $18 billion by end 2027, was the balance sheet discount that weighed on the shares before the war began. But the same conflict that generated the trading windfall also cut into production. BP expects upstream output to fall to 2.17 million to 2.22 million barrels of oil equivalent per day in Q2, down from roughly 2.34 million in the prior quarter, partly due to Middle East disruption and planned maintenance. The point most observers are missing is that this production shortfall in a rising price environment barely dents near-term earnings. The trading desk more than compensates. The real bottleneck is not production. It is what happens to the trading revenues the moment the conflict de-escalates and oil prices normalize.
This same Q2 trading statement that reported the windfall also flagged approximately $1 billion in post-tax impairments, primarily related to BP's lower carbon energy transition businesses. An additional $500 million in exploration write-offs, largely tied to the sale of BP's stake in the Bay du Nord project in Canada, compounds the charge. RBC analysts stated that Lightsource BP and Archaea could face the chopping block and see no place for either in BP's portfolio long-term. These are the assets that the previous strategy had positioned as the core of the company's future. Under Bernard Looney's 2021 strategy, BP had committed to shrinking fossil fuel production to around 1.5 million barrels per day and achieving net zero by 2050. The subsequent reset targeted 2.4 million barrels per day by 2030, approximately 60% higher than the figure in the original net zero plan. The buried assumption the market is treating as settled is that the Iran war simply accelerated a pivot already underway. What that framing misses is that the war has simultaneously destroyed the optionality that made the pivot reversible. Green assets being written off now cannot be rebuilt cheaply if oil prices normalize and the political wind shifts. The disagreement in the pool is not merely rhetorical. Greenpeace described BP's capacity to profiteer from human misery as almost limitless. The End Fuel Poverty Coalition called the results a startling reminder that when conflict drives up oil and gas, energy companies profit and households pay. O'Neill's response, that BP is working with customers and governments to get fuel where it is needed, does not engage with the scale of the windfall, which is the political pressure point. Citi raised its second quarter earnings per share forecast by 18% on the back of the update. Those two realities, political exposure and an analyst upgrade, sit simultaneously on the same share price, and that dual pressure is precisely what leaves both holders and watchers without a clear read today. The resolution of the central question, whether the war windfall is converting into durable shareholder returns or merely masking the cost of a failed strategy pivot, arrives on 30 July when BP publishes full second quarter results. That is the first date at which O'Neill can announce the next share buyback program, update dividend guidance, and provide the market with a confirmed debt trajectory. The debt mathematics already point toward an answer. Net debt at $22 to $23 billion against a 2027 target of $14 to $18 billion implies BP needs another $4 to $9 billion reduction over roughly 6 quarters. At the current pace, a more than $3 billion reduction in a single quarter, that target looks achievable if oil prices hold. For a watcher considering entry, the discriminating variable is not the Q2 profit headline. That is already largely in a share price up a third over the past 6 months. The variable that decides the thesis is whether the 30 July results confirm the buyback's return, alongside a debt trajectory still on track at a lower oil price. If O'Neill announces a buyback program and guides debt toward the lower end of the $14 to $18 billion target, the Iran windfall is converting into structural capital returns, an entry setup. If she signals caution, defers the buyback, or if the $1 billion green write-down proves to be the first charge in a larger impairment cycle, the rally was a geopolitical trade rather than a thesis reset, a trap. For holders, the single checkpoint before acting is the buyback signal on 30 July. That is the moment the war windfall either locks in as a durable return or reveals itself as a temporary patch on a balance sheet still carrying too much debt and too little strategic clarity.